Welcome back. In this video, I am going to discuss the most popularly used indicator, which is the Relative Strength Index. This indicator is commonly known as RSI. Even if you are new to financial markets, chances are you have heard of this indicator thanks to your TV studio analysts. But surprisingly, the way these analysts use this indicator is often not accurate. So even though you may know broadly how RSI works, you should still watch this entire video because you are likely to find something new here. RSI is used to graphically compare a security's gain with its losses over the set period. The creator of the RSI, which is Wells Wilder, recommended a 14-day time period. This is generally the default period used in most softwares. RSI is a momentum oscillator which provides information on whether an asset is overbought or not. The formula for RSI is shown here. In order to compute RSI, what you need to compute is something known as RS. RS is calculated by this formula shown here. RS is calculated by dividing the sum of up changes in the period by the sum of down changes in the period. You see here that we have used the mathematical mod operator here. Since down changes in the period will be negative, this mod operator is used to ensure that RS is always positive. Also, by ensuring that this term RS is positive, we make sure that RSI oscillates between 0 and 100. In general, a value above 70 in the RSI represents an overbought situation, and a value below 30 suggests that the asset is oversold. While the range of 30 to 70 may be a good rule of thumb, but you will find that some stocks actually trade in a much narrower range. You will see that less volatile stocks may have their RSI value oscillate in a lower range, and highly volatile stocks may have their RSI values oscillate in a broader range. So you might find that normal range of RSI for some stocks is say 40 to 60. In such a case, you should treat values above 60 as overbought signal and values below 40 as oversold signal. Now let's look at an example to understand multiple concepts related to RSI. This chart here shows several aspects of the use of an RSI. For example, because the RSI oscillator was higher than 70 around here, so one might think that one should sell the stock because it is probably overbought. Doing so, however, would have been a mistake as you would have missed a significant advance. A more careful analysis should take into account the trend. The trend indicates that the stock is in an uptrend. So RSI readings above 70 could be expected in a strong uptrend. Since RSI is a price-based oscillator, you can use trend lines to analyze it. As the chart here shows, both the share price and the oscillator were in an uptrend, but the RSI uptrend was broken on 22nd of February. This was a potential warning that the uptrend in price might have broken down. So subsequently, you see that the share price broke its uptrend support line as well. With this, we have come to the end of our discussion on Relative Strength Index. In the next video, we are going to look at another oscillator known as the stochastic oscillator. So see you in the next video.